Insurance claim. We are going to cover two aspects here. You could insure your stock. So in any accident or theft, if you lose the stock, you can claim the compensation from the insurance company. Okay. Another one is insurance of your earning power, profit. Okay. So we need to know what is the stock we have at the time of sale, at the time of accident. See, most of the cases, if I have the asset, no issues. If I lose the asset by fire accident or flood or whatever the case may be, can simply intimate to the insurance company to claim the compensation. But in case of stock, do you know how much stock you have on the date of fire accident? Not possible. You will take the stock only in the year end, 31st March, stock taking. But roughly you can estimate what could be the stock available in your godown. That will be calculation part in this insurance claim. And estimated stock you may hold at the time of fire accident is calculated by using some rough calculations, like an intimate this to the insurance company, and you will get the compensation. How do we get that, sir? Very simple, by preparing the trading and P&L account. Especially by preparing the trading account, you can finish off. So on preparation of the trading account, sales, opening stock, purchases, closing stock. Sorry, purchases, GP and closing stock. The GP as well as closing stock, because closing stock lost in fire accident or theft or whatever reasons may be. Usually if we get the closing stock value by physical verification in the year end, post that value here and the balancing figure will be the GP, and GP can be easily found out here. But in case of loss of stock, we don't know the value of closing stock, we don't know the value of the GP, both. If two items are missing, then it's really tough. Then how can we calculate, sir? You can calculate GP based on certain percentage on sale. That percentage will be equivalent to previous year's average. Average GPR ratio may be taken. Apply that on the sales, and you can estimate the GP, and you can find out the closing stock as the missing data. Probably sales may be 100. Previous year average GP are being 20%, then the GP in this case being 20. If opening stock is being 10 and the purchases being 60, then automatically what happens? 70, 90. So the closing stock can be found out by way of missing data, 10 rupees. Is that okay? This is the basic one. So you have to prepare the P&L account or trading account of the previous 2 or 3 years and find out the GP and take the average of that. That average is used for calculating the current year's GP up to the rate of fire accident or some other accident. But here the main trouble is, in case of advanced problem, the sale may comprises two varieties of sales. Probably good goods sale and damaged goods sale. Usually good goods may generate a decent GPR being 20%, but damaged good may not generate that much extra. Then you have to now segregate the good goods item and damaged items separately. For the good goods item, you can use the average GPR being 20%. For the damaged, whatever the information given in the question is the base to determine what would be the closing stock value or GPR, GL we earned in this. Okay, so that's how we can segregate. This is how we can find out what could be the stock we hold at the time of fire accident or any other loss. Next, this is the first part. Next part is all about. First one is measurement of stock. Second one is all about finding the loss of stock. Third one is all about claim raised after applying the average clause. Okay. Now what about this one, sir? Profit. This is called consequential losses. Consequential losses. We'll try to finish up the stock insurance first, then I'll explain what is called consequential loss or insurance of profit lost. Okay. So here we have three steps. Step number one is all about finding the stock on the date of any accident. Opening stock plus purchases minus cost of goods sold, which is nothing but sales minus GP. How do we calculate the GP? Based on the previous year or previous year's GP divided by previous year or previous year's sales. Either you can consider only the previous year's data, or you can consider 3 or 4 previous year's data and take the average of that. While calculating the gross profit percentage, need to consider abnormal losses and special items sold at a different sale price. Some damaged goods, some goods may be in huge demand for a short time. Then we have the time, means the period to inflate the price to capitalize the revenue. These are the things that are going to be adjusted. Step number one. Step number two is all about finding the loss of stock. How many rupees worth the stock lost? Loss of stock, which is nothing but stock on the date of fire accident calculated from the previous step. And go and verify what the stock balance we have in the go down. So it's not possible to lose all the, it is not necessary to lose all your stocks you have. Probably at the time of fire accident, you may have, say, 1 lakh rupees stock. But after the fire accident, if you go and see, yeah, of course, there may be chances of recovering around 20 or 25,000 rupees worth of stock, right? If you are able to recover any stocks even after the fire accident, is called salvage value or stocks recovered. So 1 lakh being the value of stock you have as in the date of fire accident, and salvage value recovered being 20,000 rupees. If you subtract this, then 80,000 rupees will be called loss of stock. This is called loss of stock. Clear? So you can ask for the compensation only to the extent of loss of stock, not for the entire stock you have on the date. It's 2 steps. Third step is also about claim admittability. That claim admittability is based on the average clause. Average clause. Understand? See, the policy could be, okay, what? Complete or full policy or partial policy. Okay, partial policy. What does it mean? You assume that the stock you have as on the date of accident being 1 lakh. You state to the insurance company, sir, I have stocks worth rupees 1 lakh. I need to insure the entire 1 lakh rupees. Okay, entire 1 lakh rupees. I take the policy amount or policy value being 1 lakh, stating the stock available as in the date. Right, this is called complete policy or full policy. Clear? Now, the department, means insurance company, says, sir, you have to pay me 10,000 rupees premium. Okay. Sir, I cannot pay 10,000 rupees premium. Oh, is it not so? Then you can partially insure. Partial insurance means take the policy value of rupees 6,000 only. 60,000 rupees only. Pay the premium only 6,000. So you are not able to pay the premium for the entire stock you have. Is that okay? Because the premium may be higher. You say leaving uninsured may be riskier. Insurance with the full value will be costlier. I need to stand anywhere between these two. That's called partial insurance. How many of you taken your life insurance? Do you have any life insurance with you? No, sir. Life itself, question mark, sir. Then why do you want to insure further? Any life insurance do you have? At least your parents may know. Have taken any insurance policy on you? Anybody? Immediately if you get the job, then a new friend or relative will come to your home promoting, selling the insurance company product. Happen in your home? If your brothers and sisters got job, immediately the next day insurance agent will come to your office very often. Then only realize we have so many relatives and they will get so many appreciations and all. Oh, you are great and all. Finally, there's a form. Right. See, you may be worth crore rupees. You may be worth crore rupees. Is it so, sir? Naturally. You may be worth crore rupees. But what the problem is, all these things are Completely fixed asset, not saleable. I have the big building like Taj Mahal worth rupees 10 crore rupees, hundreds of crore rupees, but I don't have the cash to. Why it was that? That may also happens. Right. See, we are worth rupees 1 crore, but if you want to go for the life insurance policy, I will take only for 5 lakhs, sir. 2 lakhs, sir. Why? My worth may be 100 crore rupees. I can imagine for over boosting myself. But if they ask for the premium, then it's so shocking. Sir, I'm not worth at all, sir. Don't take any insurance. So it is not necessary for the complete value, the insurance policy may be taken. Hope you will be now able to understand the difference between partial insurance as well as complete insurance. If you take partial insurance, then claim you can ask, also be sanctioned only to that part. In this case, as your money is 1 lakh, 100% insurance taken. In the second case, only 60% is insured. Out of the 1 lakh rupees of stock you hold as in the rate of fire accident, the policy taken is for only 60,000, so 60% here 100%. Here 100%. Hope you will be now able to understand. If you claim 80,000 being your loss of stock, in the first scenario, 80,000 into 100% can be enjoyable. How much you can claim? Entire 80,000 may be sanctioned. But in this case, only to the extent you covered your value for policy will be sanctioned. So only 60%. Okay. 48,000 compensation may be paid. Clear? This is called partial. Sir, what happens, sir, if I take the insurance for 1,20,000 rupees, but the amount is only 1 lakh, also restricted to only 100%. You cannot get more benefit of that. Is it also possible, sir? Who knows that exactly as in the rate of fire accident, sudden sale happened because of that usual stock you hold maybe 150. Because of the sudden sale on the date stock is only 1 lakh. There may be chances the stock value may be, policy value may be higher. Though the policy value is higher than the stock, but you are eligible for claiming only to the extent of claim rise to 80,000 rupees. So if the policy amount is 100, stock value is 80. So the policy amount is higher, then it is full insurance. Okay, claim will also be admitted fully. If the policy amount is 100 but stock value is 120, then it's partial insurance and partial claim only applicable. So these are the 3 steps are involving in the case of loss of stock. So this topic is very user friendly. You can finish up just like that. And second component in this case is all about profit insurance. Consequential losses. For example, fire accident occurred in your premises on 1st October 2025. You hold stock rupees 1 lakh on the date. Salvage value and amount stock record being 0.2, so 0.8 lakhs lost as on the date. As you insure, you can get the compensation for this 80,000 rupees, no problem. If you are having the full insurance, then you will get full value, otherwise partially you will be getting. That one will not actually compensate your actual loss, because you are talking about stock loss, but because of the fire accident, rebuilding that business takes at least 3 to 6 months also. Right. Fire accident, entire godown lost. Now you have to take the time to reconstruct the godown, and you have to build the business fresh for at least 3 more months or 4 more months. During the 3 months to 6 months, your business gets disturbed. So because of your business gets disturbed, what happens here? Your case, the profit you could have earned in that 6 months may be lost. The profit you could have earned for this 3 to 6 months, if you are able to run the business in a normal course without fire accident, you can earn around 50,000 rupees. Because of fire accident, your business gets distracted and you will get only 10,000 rupees. Then another 40,000 rupees revenue loss over the 6 months period also be insurable. That is called consequential. What is the consequences because of the fire accident? Business gets disturbed. It's not only stock lost. It also creates some business loss. Because of that, the normal revenue generated also disturbed for a couple of months. So that time also you can insure. Again, average class will be there. What are the average classes there? Probably this amount you can insure. You state that for this period, for the 1 year period, I can generate around 1 lakh rupees is my expected profit. So I can insure for 1 lakh by paying the premium. or I can insure for only 50,000 rupees partial insurance also possible. Second, what about the disruption period you expected to get the compensation? Sir, whatever the fire accident or things happening in my life, I need to have a coverage for 3 months or 6 months. That way also you can extend the period for the consequential losses. If my business gets stuck with fire accident, some other accident, usually I expect around it takes 4 months, sir, to recover. So I can insure for 4 months. I now pay the premium for 4 months profit. If it actually happens that distraction for the 4 month, whatever the revenue I lose, I can get the compensation. But the premium may be around 5,000 rupees. I want to reduce the premium. Sir, don't insure for 4 months, sir. Insure for only 3 months. Also average class. Two average classes are there. What are the average classes are there? Duration based average class. Another one is amount based average class. This is called consequential losses. This is called consequential loss. I can insure for 3 months or 4 months. I can insure for profit. This period also be extended. As per the extension, you have to pay the higher premium, and as well as profit also be extended. Your profit may be 1 lakh complete profit. You can insure for the complete profit, or you can insure for the partial profit. So these things are possible. We'll now first finish up these three steps. Stock insurance. So I have given the format here: stock insurance, loss of stock. So these are the 3 steps. For the year ending 31st December 2024, the sales, purchases, opening stock and closing stock of the trader, respectively, some goods were destroyed by fire without realization of any assets, any value during the year. If the trader earned a GP of 25%, calculate the value of the goods destroyed by fire. You can simply prepare a memorandum trading code, or you can work out as a statement, no problem here. You can either way, you can work out. So, opening stock, purchases, and sales, closing stock, and GP. Here, sales being 5 lakhs and opening stock being 3 lakhs 80. Oh, purchases 3 lakhs 80. Opening stock 65,000. Some goods were destroyed. Now, closing stock given here being 52,000, and there is another goods also be available. We are not given that information. Lost goods. Now the GB percentage is given here, which is 25%. So 25% and 5 lakhs being 1,25,000. Yes, find out the closing stock value of some missing data. 5 lakhs 70,000. Am I right? 5 lakhs 70,000 rupees, and your closing stock should be 70,000 rupees. But when you verify, you got only 72,000 rupees worth of stock in our godown. So we assume the remaining may be stock lost in the fire accident, balancing figure 18,000 rupees. Clear? Shall I move on to the next one? Make it faster, online students. Now, question number 2. The godown of Kodiak Limited was engulfed in fire on 31st May 2024, as a result of which a part of stock burned to ashes. The stock was covered by fire policy 2 lakhs, subject to average clause. Okay. So the records of the company reveal the following particulars. Actual value of the stock being 4 lakhs. Okay. But the policy value being 2 lakhs. Salvaged item being 90,000 rupees. Then from stock, if you subtract the salvage value, 3.1 lakh will be the loss of stock. Loss of stock. Clear. And as we have the average class, what happens? Claim, though you demanded for 3.1 lakh, you will not get to the 3.1 lakh, because out of the stock available, you insure only for 2 lakhs, 50%. So only 50% of the claim may be sanctioned to you. Yes. How much? 1,55,000. So claim is equivalent to loss of stock multiplied by policy amount divided by average stock. Loss of stock being 3.1 lakh into policy value being 2 lakhs and average stock being 4 lakhs. 1.55 lakhs will be the claim admitted. Now let's move on to the next illustration, question number 3. So I explained how to calculate the value alone separately, how much of claim is admitted separately. These kinds of questions you may expect in your examination carrying 2 marks, 3 marks like. There will not be complicated topic or illustrations from this topic. Very easily you can score 2 to 3 marks. Okay, in this particular content. Now, question number 3 is a comprehensive illustration. On 31st December 24, the premises of Nagar Limited were destroyed by fire, but sufficient records were saved from which the following particulars were ascertained. So, the destruction happened on 15th December 24. Okay, probably we assume this is being the financial year. In valuing the stock for balance sheet, as at 31st March 2024, 6,900 had been written off for certain stock. So 31st March 24, 1st April 23. This is previous year. This is the current year in which the loss happened. This is what about the date of destruction. Date of destruction. So usually we prepare what? Memorandum trading account for this period. Memorandum trading account. What is called memorandum? Memorandum is nothing but rough work. That's how we can understand. It's not a accounting statement. By preparing the trading account, I can easily find out what could be the stock held as in the date of fire extent. Anyhow, it is not going to be my part of accounting record. Only for finding any missing data, if I am preparing as a statement, that is called memorandum trading. So this is all about the memorandum trading. But why do we have the information for the prior to the previous year? To find out what could be the GP earned in the previous year. So the prior year's GP ratio may be expected in this current year also. So by preparing the memorandum trading account, you have two items to be calculated. One is closing stock, another one is GP. Where GP can be easily found out using the GPR applied in the previous year to be used in this current year. So that one value, closing stock, can be calculated as a missing data. Stock at cost on 1st April 2023, all this information are there. So you have to prepare trading account for this period and you have to prepare memorandum trading account here. Yes. Yeah. So we'll prepare trading account as well as memorandum trading account both. Trading account for the year 23-24 and memorandum trading account okay, up to the date of fire extent. Fire extent happened on 15/12/24. Is that clear? Now all the available information I may finish up feeding. Yes. Opening stock in the previous year 2,20,500. To opening stock 2,20,500. And closing stock in the previous year 2,38,800 and purchases less return up to the last year's end. Purchases less return 11,94,000. Sales less return 14,61,000. Purchases less return in the current year. The closing stock of the previous year becomes the opening stock in the current year 2,38,800. Current year the purchases up to the date of fire extent being 10,15,000. 10,15,000 and sales less return. Sales, this value being 11,62,000 rupees. I just fed all the available information here. Unless any adjustments given, you can calculate the loss of stock easily by tallying the trading account of the previous year to get the GP. Using the GP, GPR is found out and that GPR can be applied in the current year to find out the GP also, right? But here adjustments given. This one. What's that? In valuing stock for the balance sheet as at 31st March 24, 6,900 had been written off for certain stock, which was a poor selling line having cost rupees 20,700. So now you have to write down, okay, one of the item. See here, this is total. I'm going to segregate that to normal as well as abnormal. This will be named as abnormal item. This is total. Normal, abnormal, and total item. In that current purchases, which includes 20,700, has poor selling line. So it was written down gross loss by 6,900. Okay, this item can be saleable lesser by 6,900. Definitely there's a loss only. Saleable, not at sold. Not at sold. Clear? A portion of these goods were sold in June 24 now. So we'll finish up the trading account for the earlier year first of all. Opening stock, we assume that all the opening stock related to the normal goods only. Out of the newly purchased item, 11,94,000, 20,700 being abnormal item. So balance being 11,73,000, 11,73,300 being normal. Normal item. This normal item remains unsold. Sorry, abnormal item. We'll try to finish up the abnormal item first of all. By telling the abnormal item, one of the items being damaged one, so we can sell it at a lesser value rate. So 20,700 minus 6,900, we can sell it for 13,800 only. 13,800 only. Is that clear? Now, what about the balance item? 14,61,000 is nothing but this balance item sold. What about the closing stock of the balance item? Come on, find out. You have to subtract these two values to find out the closing stock value from this. How much is that? 2,38,800 minus 13,800 and 6,900. How much is that value? Otherwise, gross loss will be in total 6,900. Dash. You can finish up tallying the. Yes, tell me. In case of normal, what is the closing stock you are getting? Okay, you need to get the GP and closing stock being the difference between these two. Come on, tally this first of all. Total column 17,06,700. Am I right? 17,06,700. Your GP in this case being 2,92,200. Now what about the closing stock? Come on, get me this value. 2,25,000. 2,25,000. The closing stock shown at its own cost. Cost means one of the item included in this being 20,700, but today the sale value of that being only 13,800. Any of the remaining goods 16 lakhs, 86,000, 16 lakhs, 86,000, and you can find out the GP easily. GP in this case being 2 lakhs 92,200. Normal column. You have to find out the GPR for the normal goods. Forget about the abnormal. I need to find out what is the normal profit if there is no any abnormal items in our stock. So abnormal column will be separate and it will be dealt separately as per the instruction given. Whatever the balance left over will be the normal item. Okay. Are you getting this? No. No. You have to subtract these two. 2 lakhs 38. Okay. I will be getting lesser. If you subtract 13,800, you will be getting correct answer. Okay, then it may be assumed the other way. This 2 lakhs 38,800 is after written off. So I have to now include that 6,900 here separately. Clear. Then this 22 stock at cost on this date. In valuing stock for the balance sheet as on this date, 6,900 had been already written off. So this value is after subtracting the 6,900. Then okay. It is assumed the 6,900 was already subtracted. Okay. As the 6,900 is already subtracted, separate it. The closing stock value being the summation of these two, we now segregated the written down value, written off value as well as balance good value, right? Now find out the GPR. GPR should be calculated only for what? Normal scenario. GP by sales into 100. We should not care about the abnormal item. We need to consider only the normal item. The normal GP being 2,92,200 and sales being 14,61,000. And you can represent that in terms of percentage. 20% will be the GPR here. 20% will be the GPR. Now, previous year opening will be the closing will be the opening for the next period. Now, opening stock value here being 2,25,000. Normal goods 2,25,000. Abnormal goods value being how much? 13,800. This is the total inclusive of these two. This 13,800 is after written off of the value. The value was already written off by 6,900. Right. In this year, we purchased 10,15,000. We assume the entire purchase being normal goods only. Unless specifically stated, you don't assume this is being abnormal item. 10,15,000. Right. Now, this damaged item, a portion of these goods were sold in June 24 at a loss of 750 on the original cost of rupees 10,350. Right. 20,700. Okay. This is the original value. In that 10,350 worth asset stock sold after a original loss of 750. 9,600. Okay, 9,600 is the price at which it is sold. So 9,600. So 9,600. The remainder of the stock was now estimated to be worth the original cost. Balance is worth 10,350. We thought it will not be saleable for the same cost price. It may be recoverable or it will recover only lesser value. But on the subsequent year, 50% sold with a small loss only. Another 50% will be recoverable with the original value. Is that okay? Now we can record this here. Sales. Normal item, abnormal item, and total item. And we have closing stock. Closing stock for the abnormal item being 10,350 and sale value of the abnormal item being 9,600. Hope you will be now able to understand. Abnormal will be separately worked out, normal will be separately worked out. Okay, hope you will be now able to understand the abnormal column. Subject to the above exceptions, gross profit had remained at a uniform rate throughout. So, leaving this, all other stocks will be generating 20% revenue. Stock salvaged value being 17,500 and policy value for rupees 2,50,000 rupees. 2,50,000 worth the stock were insured. If you have the closing stock as on the date of fire accident more than 2.5 lakhs, then automatically average class will be applicable. Average class will be applicable. Yes. Come on, find out the GP here. In case of a normal item, what's the value? 11,62,000, 9,600 being the revenue from sale of abnormal item. Sale of normal item will fetch how much? 11 lakh 52,400. 11 lakhs 52,400. Is that okay? And GP being in the normal 20% will be the GP. How much is that? 2,30,480. Now finish up tallying the normal and abnormal column separately. In case of normal, 14 lakhs 70,480. 14 lakhs 70,480. And you will get the closing stock balance here. 3 lakhs 18,080. In case of abnormal, 19,950. 19,950. GP from here being 6,150. Now find out the total. Total being the summation of these two will be the total GP. 2,36,630. 14 lakhs 90,430. 14 lakhs 90,430. And the balancing figure being 3,28,430. Now the stock value is higher than the policy amount, then definitely will get lesser compensation only. Now loss of stock. Loss of stock. Closing stock minus salvage value. 3,28,430. 3,930. Loss of stock. Loss of stock. The next one being claim. While raising the claim you asked into policy amount divided by stock value you have. Okay. So this will be applied only when the policy value is less than the stock value. So here it's less than stock value. So partial insurance, then automatically you will get only partial loss being your claim. 3,28,430 into means the policy amount being 2,50,000 and your stock being 3 lakhs. Oh, okay, okay, okay. Claim being 3 lakhs, otherwise loss of stock. 3 lakhs 10,930 you asked, but they will give only this much. 2 lakhs 50 divided by 3 lakhs 28,430. What's the final value? 2 lakhs 36,679. Consequential loss by fire. Okay. Otherwise named as loss of profit policy. Either it may be named as loss of profit policy or consequential loss by fire. In this case, first you have to find out step number 1, loss of profit. Loss of profit. How much your profit is lost due to the fire accident? After the fire accident, to get back to your normal business, it takes some time, 3 or 4 months. During the 3 or 4 months, you lose your sales and ultimately it causes reduction of your profit. Loss of profit. That is called loss of profit. Right. Second one being increased cost of working. Increased cost of working. Okay. So 3 months got your business distracted. Your profit reduced due to that distraction being around 50,000 rupees. Not only that, during the period you need to have some temporary arrangements to run at least some business. Further, you spend some money, that can also be claimable. That can also be claimable. And third one being any savings in standing charges, any savings will be subtracted. This is what about your total claim. This is what about your total claim. Clear? So I think I lost around 1 lakh rupees, sir. And my business gets totally distracted. No, that building all collapsed. Nearby, I prepared immediately. I developed a hut or shed. Using the shed, I did my business. For the shed and other thing, I spent some additional cost. Can I claim this also as a compensation? Of course, you can claim because you have to run the business. That's what about the intention of the insurance company. Run the business. So probably for constructing the shed and other thing, you spend around another 25,000 rupees. You can claim that one also. And because of the fire accident, your business got totally distracted, naturally some costs may be reduced, some fixed cost. Regular electricity bill, you may have 100 employees. Because of the fire accident, you could have terminated around 60 or 50 employees. And because of the termination, you can reduce the salary payment. And some other depreciation, other charges may also be reduced, That will be your savings only, So savings due to that, probably around 15,000 rupees. So ultimately 1.1 lakhs will be the total claim you raised. Next, will I get all the claim as my compensation? Definitely not so. The question is whether it's a partial investment, a partial or a complete policy. If it is being partial, you will get the partial reimbursement only. Here, the policy amount is more than your GP, then full claim will be recoverable. If the policy amount is less than your GP, then you will get partial compensation recovered. Okay, similar to the stock. Your stock value and policy amount. If the policy amount is more than here, whatever the claim you raised, this 1.1 lakh you raised, so 1.1 lakh into policy amount divided by GP. This extent you can get the claim. Fourth one being claim admitted. by using what? Average class. These are the 4 steps you have to follow. These are the 4 steps you have to follow. Clear? This is called consequential loss by fire. Any doubts here? Now, how do I calculate these 4 steps? Are loss of profit. Pretty simple to understand the term, but now the question is how can we calculate? The calculation of loss of profit is nothing but short sales into GPR. What is called short sales? Standard sales minus actual sales. Standard sales is nothing but sales during the corresponding dislocation period in the previous year and actual sales during the dislocation period. Okay, this is called short sales. Okay, now you have to understand what is called. So I just explained the loss of profit step number 1. Step number 2, claim for increased cost of working. Step number 3, subtraction for any savings. 1 plus 2 minus 3 will be your claim. Okay. So in this claim, you can either use the average class or you can get the entire compensation, means claim as a compensation. If the policy amount is more than or equal to the GP, then all the compensation will be provided. If the policy amount is less than the GP, then you will get proportionately. Hope you will be now able to understand. 4 steps. First, understand the 4 steps. Loss of profit, increased cost of working should also be added. If there is any savings due to the fire accident, you can subtract. That's what about your claim. All the claim may be given as a compensation or partially only depending upon the average class application. Now the question is what is called loss of profit. For example, 1/4/2023 or 24, 31st March 2025. In the current year, 1/4/2025 onwards, fire accident happened on 1/7/2025 and it affected almost 3 months, 30/9/2025. This is called dislocation, disruption period. Fire accident happened on 1/7/25. Because of that, the business gets dislocated for 3 more years, 3 more months. Now, during the period, your sales being only 1 lakh. Your sales being only 1 lakh. Now, I have to find out what is the sales of the corresponding period in the previous year. Okay, previous year 1/7/2024 to 30/9/2024. For this period, what is the sales? For this period, the sales being 5 lakhs. The difference between these two is called short sales. Short sales. Hope you will be now able to understand the short sales first of all. How much of your sales got dislocated, means affected? Short sales. Standard sales. Standard sales is nothing but the sales expected during the dislocation period based on the previous year expense period information. And what's the actual sales happen? The difference between these two will be the short sales. Provided it will be adjusted for some predictions also. Sir, previous year 5 lakhs, sir. This year the market is exorbitantly vital, good enough. Compared to the previous year, this year almost 20% sales increased irrespective of the owner, whoever it may be. Even small business owner or big business owner, all inflated their profit by 20%. Oh, is it so? Yes. Then 5 lakhs is inflated by 10%. 5,50,000 rupees. From that, 1 lakh will be adjusted. So 4,50,000 is short sales. In absolute sense, directly compare the current dislocation period sales as well as dislocation period corresponding in the previous year's sale. Directly see. Subject to the trend adjustment also be carried over. Next. And we need to find out only the loss of profit, So what is the profit in this? So GPR. GPR. Clear? You have to apply the GPR. Now, what is called GPR, sir? Again, GPR also be defined for this purpose. Actually, you will think GP by sales into 100, right? But here it is not directly GP by sales in 100. We have to study in a different manner. For example, in your trading and P&L account, GP being 100, sales being 500, and your operating cost being 40 and your net profit being 60. Is that okay? 60. How do you calculate the GPR? 100 by 500, 20% is the GPR. GP by sales into 100. But here, net profit is added with this operating cost to be posted in the numerator value divided by 500. So, net profit plus 40, 100, 60 plus 40, 100 divided by 500. That's the way you can calculate. So, what is the difference, sir? There is. What is the difference? Very, very important. This operating cost, all the operating costs may not be allowable as deductible item. Okay. In this case, we might have insured only 30 rupees. Another 10 rupees is considered as not insurable. All the costs you debit in your P&L account now. While insuring, the department says, insurance company says, no sir, we will not give any reimbursement if you are raising the claim for these sort of expenses. I will consider only 30 rupees. So this is called insured standing charges. Means all the amount debited in the P&L account capable of claiming as a deduction, means compensation from the insurance company, is called insured standing charges. So in this case, GPR is equal to net profit plus insurable standing charges divided by 6. So 60, though the operating cost being 40, only 30 rupees is insurable. So in numerator, 30 by 500 in percentage, 18% will be the answer. 18% will be your answer. Hope you will be now able to understand the calculation of loss of profit. Let me finish up that first statement. Loss of profit. Loss of profit is equal to short sales into GPR. Short sales is nothing but the difference between standard sales and the actual sales. Actual sales is nothing but the sales during the dislocation period. Standard sales is the sales period of sales affected due to the fire accident. And always remember, indemnity is equal to policy period. Cross verify. Your business got dislocated for almost 1 year, but insurance company says, no, you have asked for only 6 months coverage, I will give only for the 6 months. Cross verify. So the period will be based on actual dislocation period or insured period, whichever is lower will be taken. I insured for only 6 months, dislocation happened for 1 year. Insurance company will not give the compensation for the entire 1 year. They will give the compensation only to the extent means insurance is raised. If the insurance period is 3 months, insurance period is 6 months, dislocation is 3 months, you are eligible for entire claim. If the dislocation period is less than the period insured, you can enjoy the full benefit. Hope you will be now able to understand the point number 1. And what about the GP ratio, sir? So GP ratio in this case is nothing but net profit plus insured standing charges. Usually net profit plus all the debit items in the P&L account will be added. That's the GP. But all the debit item of the P&L account will not be taken. Only a portion which may be eligible for insurance purpose can be taken in the numerator. So net profit plus insured standing charges divided by accounting year turnover. That's how you can calculate. Hope you will be now able to understand the step number 1. Loss of profit is identified. During the dislocation period, my business gets distracted. I can resume my operation only 3 months late. Though I can resume my entire operations after the 3 months later, during the 3 months, I can do some temporary arrangements to do the business. Okay, can I do such temporary arrangement to make slight profits? And of course, company is very much happy. Insurance company is very much happy. So if you are able to generate some revenue during the dislocation period, the insurance company is pretty happy. Provided, if you spend 1,000 rupees, okay, additionally to run the business during the dislocation period, additionally you spend 1,000 rupees. But revenue is only 600 rupees. What happens here? Insurance company says, you don't do any additional expenses. After studying for a semester, your mark should increase by at least 5 to 10%. Last attempts are, in total I got 160, now 140. Then why do you go for the coaching? So always the same happens, right? So insurance company says, Whatever the additional insured, any increased cost of working, if you incur, this cost should be meaningful. Means the revenue should be more than that. Else you don't spend that money, just be idle. So increased cost of working should be always higher, lesser than the revenue. So you have to take the revenue. If the revenue being 600, insurance company says it's waste of spending. You can claim only 600 rupees. If your revenue being 1200, okay, revenue being 1200, what happens? Revenue being 600, either it may be 600 or 1200. In case of 600, you get only 600 rupees. If it is being 1200, you will get 1000. So one is loss of profit. During the dislocation period, being idle, you can do some operation. As you plan to do some operation, you can generate some income. Because of that operation, there is an increased cost. Because of the operation, you are getting generation of revenue. The revenue should be higher, else the compensation given by the insurance company restricted to only the profit earned. Otherwise, whichever is lower of these two. That's the logic. Not only these two, three items are going to be referred. So among the three, least will be addable as your claim. What are they? Increased cost of working. Is that okay? Whichever is the least of one, actual increased cost. Second, third, saved sale into GPR. What is called saved sale? So your business got totally distracted. 3 months you are not able to do any business. But because of spending this, you have made around 1 lakh rupees worth of sale. Okay. 0 will be your sales expected. Because of this increased cost of working, your sales being 1 lakh. This is no cost of working, your situation being 0. Because of spending this cost only, I earned 1 lakh, then that 1 lakh is called saved sales. Sir, if you don't spend this money, what happens, sir? If I don't spend, I may make a sales of 50,000 rupees. By spending this 1 lakh or some additional money, what is the extra sales? Sir, I earned 1 lakh 50. That additional sales you get here, this is called saved sales. My entire business got distracted. Godown lost, and that showroom lost. It's a Diwali season, and I'm selling all the cloths. Okay, what can I do? Nearby, I can lay a shed, and I can display my items to sell. So definitely the sales will be there, but not actually regular sales. Some sales disruption will be there, definitely. If I don't have the shed, what's my revenue? So if I don't have the sales, I can get only 50,000 rupees, sir. Because of shed, I can now make a sales of 1 lakh 50. The additional sales because of this cost of increased working, is called saved sales. Hope you will be now able to understand. Okay, in that saved sales, what is the GPU recognized will be found out here, GPR. And average class, like. Second point is the average class. See, in your P&L account, GP being 1000. Here, insured standing charges, uninsured standing charges. Okay, uninsured standing charges, net profit. Okay, 600 being insured standing charges, 200 being uninsured standing charges, 200 being net profit. How do you get the GPR here? GPR is equivalent to what? Net profit plus insured standing charges divided by sales. Probably sales being 10,000. Okay, 8%. Is that okay? That's how we'll get. But in case of increased cost of working, here one more calculation is there. Increased cost of working multiplied by GP divided by GP plus uninsured standing charges. Here the GP is nothing but what? Net profit plus insured standing charges. 200 plus 600, 800 should be in the numerator. In denominator, so 200 plus 600 will be the GP for our purpose. With that, you have to add the uninsured standing charges also. So numerator being 800, denominator being 1000. Only to this extent of increased cost of working is recoverable. Okay. Among the three, the least will be deductible. Least will be deductible. Clear? Clear? Now, listen, bro. Very, very important concept. Point number 2. So, point number 1 we have completed. Point number 2, claim for increased cost of working, which will be whichever is least of the three. One is actual, another one is saved sales into GPR. Saved sales into GPR. Another one being increased cost of working into GP on annual sales, divided by GP and annual sales plus uninsured standing charges. How do you calculate the GP? Net profit plus insured standing charges will be the GP. Here also net profit plus insured standing charges, but you have to add uninsured standing charges also. Hope you will be now able to understand this second point. Among the three, the least will be step number 2. Now, because of the dislocation, you can save, no? That is called savings in standard charges. Will be subtracted to get the claim. The last one you can very easily understand. Now, one more term you have to understand. What about the GPR? GP by sales. GP, in this case, the GP is net profit plus a part of the debit item of the P&L account. That is called insured standing charges. Clear? Divided by what sales? That's very, very important. Accounting year sales. Clear? What is called accounting year? Starts with 1st April, ends on 31st March. That's called accounting year. But when it is all about this case, annual sales will be taken. Earlier it is an accounting sales, here it is an annual sales. What is called annual sales? The sales for a year, corresponding just prior to the date of destruction, 12 months backward. If the destruction happens on 1st July, before 1st July, 30th June and May, like that you can go prior 12 months. So 1st July of the previous year, 30th June of the current destruction period will be considered as annual sales. So for the cost of working's annual sales for the first case and accounting year sales will be taken. Clear? Annual sales is equivalent to 12 months sales immediately preceding the fire accident. Also, the sales is adjusted for trend, if any. The sales will be always adjusted for the trend. Compared to the previous year, this year the sales is now showing a decreasing trend. Then you have to adjust. If it is showing increasing trend, then also you have to adjust this. Hope you will be now able to understand these are the 4 steps. Let's start with question number 1 so that you will be able to understand easily. There was a serious fire in the premises of Mrs. Fortunate on 1st September 2024. 1st September 2024. Their business activities were interrupted till 31st December 24. When normal trading conditions were re-established. This is what about the dislocation period. Mrs. Fortunate are insured under the loss of profit policy for rupees 42,000. So policy amount being 42,000. If the profit is less than 42,000, you will be getting partial compensation. Profit is more than 42,000, then you will get partial. Policy amount is higher, means you will get full compensation. You are able to ascertain the following information. The net profit for the year ended 31st December 23. So, year end being calendar year 1/4/2023, 31st March December 2023. This is what about the previous year. In this period, net profit being huh? January. We'll start with January. Sorry, from January to December, net profit being 20,000. The annual insurable standing charges amounted to rupees 30,000, of which 2,000 were not includable standing charges. 30 were 2 being uninsured standing charges, 28 being insuring standing charges. Okay. The additional cost of working in order to mitigate the damage caused by the fire amounted to rupees 600. Increased cost of working being 600. But for this expenditure, the business would have to shut down. So because of the increased cost of working, 600 rupees, you made a sales. If there is no such cost, you have to shut down. Means your sales being zero. Unless you spend 600 rupees, you don't make even single penny your revenue. This 600 rupees is the reason to generate the nominal sales. Then entire sales will be, entire sales in this period being only due to this additional spending. The savings is in insured standing charges consequent to the fire accident being 1,500. So savings of standing charges being 1,500. It can be subtracted as a salvage value. The turnover for the period of 4 months ended April 30, August 31, December 31. So this is what about the fire accident period. This is April 30, this is August 31st, this is December 31st. This 15,000 will be taken here. This is the sales in this period. Corresponding to this period, 1/9/2023 to this period, the sales being 95,000. Is that okay? So the sales for the year 23 given as sales for every 4 months. January, February, March, April 65, May, June, July, August another 80, September, October, November, December 95 in the previous year. Is that okay? What is the accounting period sales? Accounting period sales being for this period. Come on, tell me. You have to add up these three. This is the accounting year sales. Is it 2,40,000? 2,40,000. Now, find out the annual sales. Annual sales represents for which period? During the destruction period to prior 12 months will be taken. This is what about the annual sales. This is annual. This is accounting. Come on, tell me what is the annual sales? Annual sales means 12 months. Leaving the district location period, 4 months, 4 months, 4 months. You have to add the 3. 2,45,000. 2,45,000. That's all. This information is more than enough to solve the illustration without any more reference to the illustration. Yes, come on. First one, what is that? Loss of profit. Loss of profit. Second one being increased cost of working. Increased cost of working. And third one being savings. You will get claim loss of profit. This is called loss of profit. Okay. So here we have been given the savings being 1,500. So let me finish off calculation of loss of profit first. In case of loss of profit, how do you calculate? Short sales into GPR. Short sales is equal to standard sales minus actual sales during the dislocation period. What is the standard sales this period? 95,000. What is the actual sales happened during the dislocation? 15. Then short sales being 80. Then find out the GPR. GPR being net profit plus insured standing charges divided by accounting year sales into 100. The net profit being 42 or 20? 20,000 rupees. Insured standing charges being 28,000. Accounting year sales being 2 lakhs 40. Hope this value being 20%. So here 80,000 rupees into GPR being 20%, 16,000 being the short sales. Clear? This is what about, loss of profit due to short sales. Now we'll move on to the next one. Increased cost of working. Claim for this. Claim for increased cost of working. Whichever is the least of. Number 1 being actual. Actual being 600. Number 2 being increased cost of working multiplied by GP on annual sales. Okay. GP on annual sales divided by GP on annual sales plus what? Uninsured standing charges. Third one being saved sales into GPR. Now actual being 600. Increased cost of working being 600, GP being 0.2 into annual sales being 2.45 lakhs divided by GP on annual sales, and you have to add the uninsured standing charges, which is 2,000 rupees. 2,000 rupees. The final value being 576. What is the saved sales? This entire 80,000 rupees sold is due to the additional expenses only. So 80,000 rupees. Okay. Okay. The sale happened here being 15. The entire 15,000 is due to this additional expenses. Into GPR being 20%, 3,000. Is that clear? Yes. Tell me. Among the 3 least is chosen 576. 576. 16,000 plus 576 minus 1,500. 15,076 will be the loss of profit. Loss of profit. Clear? Now, you expected 15,076, but policy amount being how much? 42,000. What is that? Policy amount is 42,000, right? Okay. Now, claim, claim. Claim is equal to the total claim you raised multiplied by policy amount divided by GP on annual sale will be taken. Here also annual sales. Okay. Total claim raised by you is 15,076. Policy amount being 42,000. GP being 0.2 into annual sales being 2,45,000. Already we marked this value. Yes, find out the ultimate value. 12,922. Shall I move on to the next one? So let's move on to the next illustration. Question number 2. Indemnity period 13 months. So we have taken insurance policy for covering 13 months. So more than 1 year we have the policy amount. And sum insured being 2 lakhs policy amount. Turnover of the last financial year being this one. This is a accounting year turnover. Gross profit, net profit plus insured standing charges 2 lakhs, giving a gross profit rate of 20%. They have already given the GPR. Net profit plus all standing charges being 2 lakhs 50. So standing charges being 2 lakhs, all standing charges 250 means 50,000 being not insured. Fire occurred on this date and affects the business for 6 months. Only 6 months. We have coverage period of 13 months, indemnity period of 13 months, but the period required for claim being only 6 months, so we are able to get the claim, no problem. Turnover 12 months ended on 31st March to 31st March 2024. means exactly fire accident date prior to the 12 months, then it is annual profit. This is annual sales. And turnover, this will be the fire occurred date. From that date to almost 6 months, the business got disturbed. In that period, the sales is 2 lakhs, corresponding earlier period being 5 lakhs. This is dislocation period. This is corresponding dislocation period in the previous year. The difference between these two is the short sales. Okay, that short sales also given directly here, reduction in turnover like 2 lakhs, reduction in turnover. Sales amounting to rupees 1 lakh 60, out of this 3 lakhs 1 lakh 60,000 generated in period of 1424 to 3924 by incurring additional expenses 60. So if you don't incur this additional cost, increased cost of working, our sales is only 1 lakh 40. The sales 3 lakhs is due to the additional cost only. Okay. Savings in insured standing charges also be given here. Come on, we'll start with first one. What is that? Profit lost. Profit lost. Okay. How do you calculate? Okay. Short sales into GPR. Short sales into GPR. What is the short sales? 2 lakhs. What is the GPR rate? Already given 20%. So 40,000 will be the value. Step number 2. Increased cost of working. Whichever is least of A, actual, B, increased cost of working, multiplied by GP on annual sales divided by GP on annual sales plus uninsured standing charges. C, saved sales into GPR. Saved sales into GPR. Okay. Now, what is the increased cost of working? 30,000 rupees. Next one being 30,000 rupees into GP on annual sales. Annual sales being this one, 11.7 lakhs, whole divided by 0.2 into annual sales 11.7 lakhs plus what? Uninsured standing charges, which is 50,000 rupees, 0.5 lakhs. What's the final value you are getting here? 24,718. 1, 2. Clear? What is the sales saved here? Sales amounting 160 generated by incurring this. If you don't incur, we don't get the sales. So saved sales being 1.6 lakhs. In the earlier illustration, all the sales is due to the increased cost of working. Here it is not so. The actual sales in the dislocation period being 3 lakhs, out of which 160 is due to this additional cost, into GPR being 0.2. What's the value? 32,000. Among the three, the least is subtracted. The least being added, which is 24,718. You have to add these two. Step number 3 is all about savings. Savings in cost, standing charges. That is directly given, 10,000 rupees you can subtract. Now come on, find out the claim. 54,718. Now, by applying the average clause, claim allowable. How much? Claim raised into policy amount divided by GP. GP and what? Annual sale. The annual sales being 11 lakhs 70 into GP 20%. What is the value you are getting? 2 lakhs 34,000. So your expected profit being 2 lakhs 34, you have to insure for 2 lakhs 34. No, but this fellow has insured only for 2 lakhs. So partial. So claim raised 54,718 into policy amount 2 lakhs, but your profit being 2 lakhs 34,000. Then claim recoverable being only 46,768. Clear? So now let's move on to the one more illustration. So with that, all the concepts are over. This illustration I included only to understand the trend. In case of trend, how can we adjust? So first illustration is a basic, another one is very, very basic. But my intention is to make you understand the savings in standing charges. Means this one, 160. Okay, for making you understand this 160 being the savings in sales, I incorporated this illustration. Rest of the other informations were directly given. In this illustration, I am going to use the trend. Use the trend. Now, the premises of XY Limited were partially destroyed by fire on 1st March 24. And as a result, the business was practically disorganized up to 31st August 24. How many months got distracted? March, April, May, June, July, August. Almost 6 months. 6 months got distracted. The company insured under a loss of profit policy. This is what about the policy amount. Right. Now, actual turnover during the period of dislocation. This is dislocation period profit, sales. Turnover for the corresponding period of the dislocation. Okay, in the 12 months immediately before the fire. Then this will be the income of the previous period corresponding to the dislocation. The difference between these two is the short sales. This is short sales. 1,60,000 will be the short sales. Turnover for the 12 months immediately preceding the fire, 1/3/23 to 28/2/24. This is the annual sales. Net profit for the financial year, insured standing charges, this is uninsured. If you add up these two, this is what of the total standing charges. Turnover for the last financial year, this is called accounting sales. Due to the substantial increase in trade before and up to the time of the fire, it was agreed that an adjustment of 10% should be made in respect of the upward trend in turnover. So there is a trend, 10% upward movement. Okay. Clear? So then instead of 240, this time it should be 1.1 time of this money. Upward movement. 240 was the previous year sales during the dislocation, corresponding dislocation period. In this year, we expect the 10% up will be there. So 240 plus 10%, 24,000, 2,64,000 will be the revised value. Now that revised value is compared with the actual sales, and that will be the short sales. Right. The company incurred additional expenses amounting to rupees 9,300. This is called increased cost of working. Immediately after the fire, but for this expenditure, the turnover during the period of dislocation would have been only 55,000. Okay, if you are not doing this, your sales will be only 55,000. Because of incurring this one, your sales is 80,000 rupees. Then saved sales is how much is that? The difference between these two, 25,000 will be the saved sales. Is that clear? If you don't incur this increased cost of working, your sales being only 55, but now the sales is 80,000 rupees. So the difference between these two is saved sales. There was a savings in the period 2,700 for insured standing charge. That can be subtracted. Number one, loss of profit. Short sales into GPR. How much is the short sales? 264 minus 80, 1.84 lakhs. GPR, do we have the GPR given directly? No. So then we have to find out the GPR. How do you calculate the GPR? GPR is equal to net profit plus insured standing charges divided by accounting year sales. Accounting year sales. Net profit 90, insured standing charges 60, 1.5 lakhs. Accounting year sales being 5 lakhs in denominator. Then GPR being 30%. So apply that 30% here. Loss of profit being 55,200. Only for this trend I have incorporated this one, else not required. Number two. Claim increased cost of working. Whichever is the least is deductible. One is actual. Actual increased cost of working being 9,300. Number two being net profit plus increased cost of working divided by net profit plus increased cost of working plus insured standing charges. Insured standing charges divided by insured standing charges plus uninsured standing charges multiplied by increased cost of working. Okay. Here we don't have the net profit for the current period, so we have to depend on this model only. Net profit plus insured standing charges being 60 divided by net profit being 90 plus 60 plus 5,000 into increased cost of working. Increased cost of working being 9,300. What's the ultimate value? 9,071. Am I right? See, if you don't have that number, GP on annual sales information, then you can depend on this formula. You can directly depend on this formula. Third one being 9,000. Exactly 9,000. What about the others? Are you getting the same? Okay, we have to adjust for the trend. Sorry, I missed that. This one is similar to the illustration, right? The same illustration. Okay. Now, 9,000 we got the answer as per the CMA Institute material. But for the trend, we have to give the importance, right? We have to give the importance for the trend also. If I use the other formula, what's that? Insured standing charges into GP on sales, annual sales, divided by GP on annual sales plus uninsured standing charges. Okay. Insured standing charges being 9,300 into GPI being 0.3 into annual sales being 6 lakhs multiplied with 1.1. For the trend, we have to do the adjustment here in numerator. Divided by GP being 0.3 into annual sales being 6 lakhs into 1.1. Don't forget to add uninsured standing charges, which is 5,000 rupees. If you apply this formula, then this value being 9,071. Actually, this point I have taken from the CA Institute material. I think this one solved directly in CMA book. There also we have trend, right? No trend. No trend. Okay. If we have the trend, and then the trend will have the impact here also. Impact here also. Make a note of it. Because we are taking the annual sales. What about the annual sales in this year? If you apply the trend, naturally 10% will be inflated. Third one being saved sales into GPR. Saved sales being 25,000 into GPR being 30%. The value being 7,500. Among the three, the least will be taken. 7,500 will be taken here. 7,500. So we have been given two models of solving this. Without trend is this one. With the trend being this one. Clear? Now finally, can I erase this part? Right. This is given in Singar Academy text also. Because I have chosen this from CA material. Currently, they have totally removed this chapter from CA Institute material itself. They don't have this as their study. And third one being savings. Savings in cost. Clearly given it is 2,700. Then the claim being you have to add these two and subtract 2,700, so 60,000 rupees. Okay. By applying the average class, you can find out the ultimate claim. So as per the average class, what is the formula? Claim released by the company is equal to total claim raised by you into policy amount divided by GP on annual sales. Again, annual sales includes the trend also. So total claim in this case being 60,000 rupees. Policy amount being 1,65,000 divided by GP being 0.3 on annual sales. Annual sales being 6 lakhs, but 6 lakhs is subject to the trend. The trend being 10% should also be adjusted for the denominator. Then final claim admitted being only 50,000 rupees. Clear? Clear? So with that, this content is completely over.